Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 26, 2025. How you doing? I appreciate you coming to this weekend review podcast. I hope it's going to be helpful for you, and I'm going to share a lot of things today that I hope is going to make a positive influence on your trading. Good week for the bulls, and good week for my trades, I'm happy to say. But the podcast, the format today for the podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the positions and all the trades that I have from last week. We're going to talk about when I entered the trade, why I entered the trades, how I position size correctly, how I place my emergency stop, how I place my end of day stop, how I go into trailing stop level, how I exit the trades if I get to serious overhead resistance, how I take partial profits each day if the market gives them to me. So we're just going to talk about how I manage the trade. And I did exit some trades. I'm still in some trades. And so I hope that's going to be helpful for you to kind of get an idea of how I look at trades, how I really what I look for are, excuse me, confluences of different entry signals, big picture ideas, supports coming in all at the same time. Really, when it comes down to it, I teach my students this, you have to look for a combination and confluence of signals happening at the same time. So uh, when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trades going forward. So we'll go over all the weekly, the daily time frame positions that I have, and then also the weekly time frame positions that I have, because I like to trade multiple time frames. After that, we're going to talk a little bit about trader psychology. Always the most important skill. I say this every week, and my apologies because I'm sure it gets old, but really it's the most important. That's why I say it. You got to get yourself a plan, everyone. You have to get yourself a trading plan. Whether you learn it from me or for someone else, doesn't matter. You just have to learn a plan. And then more importantly than that, you have to follow the plan. A plan is no good if you do not follow it. And I've traded for over 30 years now, everyone, if you can believe it. And even though I've traded this long, as time goes on, as the years have gone on, I'm more and more and more convinced, 100% certain, that the only way to make long-term profits in this game is to have that plan and to follow it. And that comes down to trader psychology. So we'll touch on trader psychology. Hopefully that will be helpful for you. It's always helpful for me to teach it, actually, because it just reinforces what I already know. But I'm human, and sometimes we have challenges. So it's great for me to teach it, and I hope it's going to be helpful for you. After that, I have gone down through my master watch list, and I do this each Friday night. I go down through my entire watch list and I identify potential trades for the upcoming week. And what I'm looking for are confluences, combinations of indicators like major moving averages, RSI levels, bullish MACD divergences, bullish RSI divergences, bullish ATR divergences, looking for things to line up. And I think my master watch list is about 77 different stocks. And, I try to get a handful. Today on the dailies, I have 12 of those. And they're not where they need to be at the moment, not yet, but they're kind of close. And that's what I try to highlight are the ones that are kind of getting close, the ones that have multiple confluences signals happening at the same time. And I hope this is helpful for you to, get an idea. You can watch these markets next week and, see if they get to the levels that I'm looking for. And if they get to those levels, then, I will definitely consider taking the trades, right? And so we'll do this both on the daily time frame and the weekly time frame. So apologize for my voice and the coughing. As you know, I've been sick. I had influenza, and I thought I was going to die. Really, I thought I was going to die. I even skipped the podcast. Haven't skipped a podcast in years, but I was just so sick. But I still have a cough, so my apologies for that. So anyway, let's get this legal disclaimer out of the way, and then we'll get rolling. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, everybody. So let's start off with the current open positions that I have on the daily time frames. This is Microsoft. And I've had a great trade on Microsoft, but I kind of zoomed out here because I want to kind of give you a big picture. But you see this green box here, right? This block, this green block. Well, this is called an order block. And, you know, the more I use order blocks, the more I am really impressed. I mean, I guess I need mesmerized, I would say, by how strong these signals are. And you know, the order block on the particular trade that I took this week stemmed all the way back from 1227.23. Now, an order block is your lowest bar close before you change market structure to the upside. Okay, I mean, that's essentially what it is. And I'm so far zoomed out here, I know it's kind of hard to see, but I'll show you some more recent ones that are easier to see. But essentially, back here in 2023, we had a lowest down bar close before we changed market to the structure to the upside. But the high and the low of that order block seems to have a memory. This is a 2-year-old memory. And that's why I extended this order block into the future. Okay, I'm just showing you this big picture zoomed out view here because I just am showing you the order block happened back here in 2023. Again, it was your lowest bar close before you change market structure to the upside, or in other words to say your lowest bar close before you took out a previous swing high and went higher. So, you know, since 2023, Microsoft has not come down and visited this order block until recently. So let's go to more recent times of when I took the trade. So I took the trade here on the 22nd of April. Why? Well, again, the order block that happened all the way back in 2023, when I'm looking for an entry on an order block, generally I'm looking for a rejection of the top of the order block. For example, here, this rejected the top of the order block and closed above. I didn't take it here, but this is an example of that. The other option is a rejection of the bottom of the order block. You can see the day before I entered the trade on the 21st, we closed below it, and then we closed back above it. And so that was my entry point. And the nice thing about this entry point, it gives me a good risk to reward ratio, and it gives me confirmation that the stock price closed below, but then there were no more sellers down here and it closed back in. All right, so I did get long on Microsoft here at 366.89 on the 22nd of April. So probably the most important thing when you enter into a new trade, everyone, 100% sure of this, is how many shares you're going to buy, right? I mean, yes, here's your legitimate entry. It's a rejection of the bottom of the order block. It closes below the order block, closes back in the order block. So great. Now you have your trade. Well, how much do you buy? Let me give you the formula that I have used for many, many, many years. And, my students and people that I have taught this to, have told me how well it works out, because what it does, it tells you how many shares to buy depending on the volatility of the market. Okay, the volatility of the market, in the last month and a half has been super high. So if the volatility is 2 times higher in the past month and a half than it normally is, that means you should buy fewer shares to account for that volatility. If volatility goes from 1 to a 3, and you normally trade 300 shares at a 1, well, if it goes to 3, now it's like you're trading 900 shares. So you have to calculate and position size based upon the volatility. And the way that I do this is there's 2 inputs. The first input is, how much do I have in my trading account? Okay. And let's just say, for example, I had $50,000 in my trading account. What I do is I take 1% of the trading, 1% of however much I have in the trading account, it's 50,000. Well, that's $500, right? If it was 100,000, it would be 1,000. If it was 1,000,000, it would be 10,000. If it was 25,000, it would be 250. Okay, so it doesn't matter. It's just 1% of total capital. So if I have $50,000, 1% is $500. Then I look over here at what the average true range is times 2. So the 2 ATR, 2 times the average true range. Right now it's 29.42. So I take that maximum allowed loss, 1% of my total trading capital, divided by the 2 ATR. That tells me to buy 16.99 shares. Okay, so I'll just round that up to 17 shares. If volatility were to fall by half, then this would increase. This would increase twice. If this were to increase double, if volatility doubled from here, then this would reduce by half. So the equation, the math equation is very easy, right? You just have to get your ATR on your screen, average true range, and then do the function where you can do 2 times the average true range, so that you have a 2 ATR. Take 1% of your capital. Again, if I have $50,000, 1% is $500, divided by the value of the 2 ATR. And there you go, 17 shares. And then, like I said, the nice thing about this, you are position sizing correctly based upon 1, how much you have in your trading account, and 2, what the current volatility is. So I have my entry, close below, close back into the order block, so a rejection of the bottom of the order block. I enter at 366.89. I position size, like I just showed you, 17 shares. Now the first thing I do is I go right back to what my 2 ATR was. Okay, my 2 ATR was 29.42. So I immediately place an emergency stop exactly 29.42 below my entry price. So just 366.89 minus 29.42. Here you go. This is your emergency stop down here my emergency stop down here at 338.40. Now, if I have 17 shares and it goes down 29.42, how much have I lost? I've lost the $500, right? Because we just did the math. 500 divided by 29.42. So that's your emergency stop. That's your, basically your worst case scenario. But the good news is that only happens about 5% of the time that you hit your emergency stop. The other 95% of the time, if you have a losing trade, the way that I set up these trades is that I look for my end of bar stop. So I always have 2 stops. I have an emergency stop and I have an end of bar stop. Well, my end of bar stop is simply a close back below the low of this order block, because that's why I took the trade. It closed below the order block, closed in the order block. The low of the order block's 362.80. So if the next day it had just closed back below, okay, I take a loss. But it's not going to be a 1% loss. It's only a 1% loss if it closes all the way down here at my emergency stop, right? If it closed, about halfway to it, then I'd lose the 0.5%. But the point is, you set your emergency stop for basically your worst case scenario. But again, it only happens 5% of the time. The other 95% of the time, it's going to be less than 1%. And the best trades are the ones where your entry is as close to your end of bar stop as possible. And again, my end of bar stop is just a close below this order block. All right. So we've taken a look at why I'm taking the trade, because of that long-term order block. We closed below, we closed back above, position size correctly. My emergency stop is 2 ATRs below. My end of bar stop is a close below the low of the order block. The close, that's the important part, the closing price. With the emergency stop, if it ever gets there, it doesn't matter if the market just opened or if it's in the middle of the day or it's closing, that is taken immediately. I don't wait for the end of the day. But my end of bar stop is called an end of bar stop because it is the end of the day. If it closes below the low of the order block, I'm simply out. Okay, so the next thing that I do is that I place my 1.5 ATR trailing stop level. You can see right now the 1.5 ATR is 2207. So what I do is I take my entry price, I look for the value of the 1.5 ATR, and I put it above my entry price. And if we get to that trailing stop level, then other rules kick in, okay? So I entered here 366.89. I placed my 1.5 ATR trailing stop level. Okay, so what that means is if we get to trailing stop level like we did on Thursday, now I go into trailing stop mode, which just means if I now in the future have a close below a previous bar's low, as a precautionary measure, I will get out of half of the position. Because for the market to come down, very likely, most often, it's going to have to close below a previous bar's low to do that. Okay? And so if that happens, that's what I'm saying. It's a precautionary measure. Okay. And so now everything I've talked about so far, the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. Or in other words, if the market goes against me, then I take action. Okay, they're defensive moves. But as with any good sports team, and I consider trading a sport, in my opinion, you need to play offense as well. Okay, not just defense, but offense. And the way that I play offense is I take partial profits each day if there's a move from the previous bar's close by a certain amount. And I'll show you exactly what I mean. So what I do is I take the closing price of each day. So the closing price was $391.85. Do you agree? $391.85. Then I look for the value of the 0.45 ATR now. And the 0.45 ATR is 662. So I take the closing price, $391.85, plus 662. My first profit target for Monday is $398.47. So let's just put that up there. $398.47 is my first profit target. Okay, it's the closing price plus the value of the 0.45, which is 662, $398.47. That's my first profit target. The second profit target, the way that I find that is I just take the first profit target, $398.47, plus again the value of the 0.45 ATR, 6.62. 405.09. So my second profit target for Monday is, what did we say? 405.09? 405.09 is my second profit target, and I always place 3 of these every day. Take the second profit target, 4509, add the value of the 0.45 to it again, plus 6.62 for 1171. Okay, so there are my 3 profit targets for 1171. My 3 profit targets for Monday. Now, if it goes down on Monday, doesn't hit any of the profit targets. Maybe it goes up enough to hit 1 profit target. Maybe it goes up to hit 2. I'm really lucky, maybe it goes up to hit 3. But the question is, well, how much profit do I take at these profit targets? So what I do is I take 10% of however many shares I'm going into the next day with. Let's say I have 100 shares. Well, I would place 10% profit target at the first, 10% profit at the second, 10 at the third. So if I have 100 shares, 10, 10, and 10. And, it's unlikely that you hit 3 profit targets, but certainly possible. To hit what profit targets? Very likely. 3, not so likely, but it certainly happens. I've hit 6, I've hit 7 in a day, but I usually just do 3. So that is the offensive part of the equation, right? If it moves up enough and I'm taking off shares into strength instead of just taking off shares into weakness. Okay, so let's revisit the trade now that we've kind of covered all the bases. We have the long-term order block. We closed below, we closed above into the order block. That is the entry. I entered at 366.89. Okay, I position size like we just went over. First thing I do after I position size and enter the trade is I place my emergency stop 2 ATRs below. My end of bar stop is a close below the order block. I place my 1.5 ATR trailing stop level above, and away we go. The next day, gaps up, hits multiple profit targets. So right off the bat, I've reduced my position size, locked away some profits, and reduced my position size, right? The next day, huge day up again, thankfully, and we get to trailing stop level. Now, it doesn't mean that I do anything. It just means now I'm in trailing stop level, meaning in the future, if I close below a previous bar's low, I will sell half. Friday, up again. So no trailing stop happened. Now, Monday, if we closed below Friday's low, I would sell half. If it keeps going up, now I have the 3 profit targets that we just went over. All right, so I have a plan. I don't care what Microsoft does on Monday. I know what to do. And this particular trade doing very well, currently up about 6.41% in 3 days, based upon the close under and then the close back into the bullish order block. Now, we do have earnings coming out here on the 30th of April. Me personally, I do not hold through earnings. It's a good way to make a lot of money quickly, but it's also a good way to lose a lot of money quickly. And, as traders, really our number one responsibility is to conserve capital and not lose capital. So holding through earnings is really a good way to lose a lot of money quickly. So we don't want to do that, and I don't want to do that. And so that's why I never hold through earnings. So anyway, currently Microsoft up 6.41% on this order block entry signal. All right, let's go to the Qs. Next trade. This one will be a lot quicker. All right, so I entered the Qs back here on the 8th of April. Again, you have the order block from the past, and so that's what was keying me off to the trade. And just on the surface, you can see here on the 8th, the price went below the order block during the day, closed back into the order block. That was the entry signal, okay? But you've heard me talk about this before if you've watched the podcast. There's something called an abandoned baby, a bullish abandoned baby or a bearish abandoned baby. This is a bullish abandoned baby, but let me take you back 2 days. You see how here on the 4th, you see how we gapped down? So overnight, the news was very bad. But then we gap down, and then the day after we gap up. This is called a bullish abandon baby. So the confluence on this particular trade was, one, we had a bullish abandon baby, and two, we rejected the bottom of the order block. And if you'd like to learn more about abandoned babies, go to my YouTube channel. There is a video there about abandoned babies and island reversals. They're very similar. It's just that one is just one bar, and abandoned babies happen with one bar being abandoned, and the island reversal happens with multiple bars, but it's the same concept. But I have a video on YouTube. You can watch that. But again, I always like confluences of signals, everyone, and that was the confluence. Gap down, followed by an immediate gap up and a rejection of that long-term order block. So I entered here at 416.26. I position size like I just went over. With Microsoft, I placed my emergency stop 2 ATRs below. My end of bar stops, it closed below the low of the order block. I placed my trailing stop level 1.5 ATRs above. The next day just ripped higher. And so I hit multiple, I think I hit 5 profit targets on this day, which was great. Takes off 50% of the position. And now I'm in trailing stop mode. So now that I'm in trailing stop mode, I'm looking for a close below a previous bar's low. Didn't happen here, didn't happen here. Gapped up, hit a profit target, didn't happen here. Here on the 16th of April, we had our first close below a previous bar's low after reaching trailing stop level. I took off half the remaining shares that I had for a gain of 6.75%. Next day we moved sideways. Next day we moved down, but still not closing below the low of the order block. The next day we move up, hit some profit targets. Next day we moved up significantly again, hit multiple profit targets. The next day on the 24th we moved up strongly again, more profit targets. And then Friday we moved up, but not enough for a profit target. You can see a profit target's 885. We only moved up 511, so no profit targets. But the remaining shares that I have on this particular trade are currently up 11.85%. And again, it all mainly revolved around this bullish order block. Later in the podcast, I'm going to kind of do a little bit more of a deep dive on the Qs and the SPY to kind of give you some technical levels that I'm looking at. But I'll just tell you right now, we are coming into some significant levels at this point, levels of resistance. So it doesn't mean I'm going to change my process of what I'm doing with the Qs. I'm just going to follow that. But I would be concerned about entering new positions up here, and later in the podcast I'll explain why. But the remaining shares of QQQ up 11.85%. Okay, let's go to Meta. Meta's been a really good trade so far, and again, it's an order block. This is a long-term order block that I drew into the future. You can see here on the 7th of April, look at this. We literally got to the order block and bounced almost to the penny. I didn't take this trade, but I did take the trade here on the 21st of April. Why? Rejection of the top of the order block. You see how during the day we went below it, yet we closed back above? Okay, I got long 484.13. My position size, I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level, I placed my trailing stop level 1.5 ATRs above. The next day it moves up profit targets. Next day it moves up more profit targets. The next day it moved up profit target. And here on Friday, it moved up enough for one profit target. So the remaining shares that I have on Meta, I'm in trailing stop mode. It just has not had me do anything. So with the remaining shares that I have on Meta, up 11.51%. So listen, these order blocks are no joke, and when you combine them with like deep dip buys, other things, abandoned babies, island reversals, they really are strong. I'm teaching 3 students at the moment, and we've just started to get into the order block lessons, and you know, really, it's kind of mind blowing. Um, and by the way, if you would like to learn more about order blocks and learn more about all the different strategies that I use, I do offer a one-on-one course. It's a one-on-one course in the evening time, and I think the best way to learn anything is one-on-one. But I teach you all 7 of the different trading strategies that I use, including order blocks. Teach you all the rules. It's a great course. I mean, if you really want to learn how to trade, um, one-on-one's the best, and having a teacher that teaches you but then tests you consistently, which I do with all my students. I teach them, then we look at random charts, we look at random trades, and I always tell them, you're driving. Tell me what we're doing in this trade. Do we do anything on this day? Do we do anything on that day? But I will teach you a process that is just great processes. Like I said, whether you learn it from me or someone else, the important part is that you learn it, and I'd be happy to do that, and I'd be happy to teach you everything I've learned. So if you're interested in doing the one-on-one course with me, like I said, it's 15 hours. It's a serious course, but when you're done with this trade, I promise you, you will have a lot more skills than you do now, and you'll be able to use those skills for the rest of your life. So my email is in the link of the description. Just reach out to me, and we get the conversation started. So the remaining shares on Meta up 11.51%. Okay, let's go to NVIDIA. I did close out the NVIDIA trade. So Microsoft, the Qs, and Meta are still open. NVIDIA, I did enter NVIDIA back here on the 7th. The combination of signals on this particular day, there were multiple. The first is we opened below the order block and closed back in the order block, right? We've been talking a lot about order blocks. The next signal was that we opened under the 30 RSI, closed it back over the 30 RSI. That is another signal. We had a V1 entry signal. V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So there was a huge amount of signals here. I got long, 97.74. My end of bar stops close below the low of the order block. My emergency stops 2 ATRs below. My trailing stop 1.5 ATRs above. Next day gaps up nicely. I hit profit targets, but it closed on its low. The next day we hit a huge move up and took multiple profit targets there. Now I'm in trailing stop level. The next few days went up a little bit, not a ton, but again, I'm in trailing stop mode. I'm looking for a close below a low of a previous bar's low. Here is your first close below a previous bar's low after reaching trailing stop level. I got out of half the shares for 7.08%. Now, unfortunately, I did get out at break even on the 21st of April. Why? Well, in the deep dip buy approach using an under 30 over 30, I have a rule that if I enter the trade, if we are under 30 over 30 and we get to trailing stop level, then in the future, if it ever gets back to my entry price, I get out of the trade. Because under 30 over 30s tend to go up strongly, and then a lot of times they come back and even go lower. And so that's why I built that rule in. But in this case, it did not. So again, under 30 over 30 rejection of the order block, but because part of the trade was an under 30 over 30, once it got to trailing stop level, then if it comes back to my entry point, I'm not going to let a nice big gain and turn into a loss. And unfortunately, I did have to get out of the other half of the position at break even, which is fine. I still had great profits here. I still had great profits here. I took some profit targets along the way here, and then of course took half of the entire shares with the close below. But obviously you can see what NVIDIA did since then. But listen, sometimes your rules are going to help you. Sometimes the rules are going to hurt you, but overall they're going to help you, and you need to stick with it. So the remaining shares on NVIDIA I got out because of that rule at break even on the 21st of April. All right, let's head over and talk about the weekly trades. Okay, so this is a weekly trade on TLT, which are U.S. Treasury bonds. I did enter this position quite a long time ago. I entered at 87.20. I entered on the 17th of January. So I've been in this trade definitely for a while. And why did I take the trade? Well, you see the order block. You see the green order block. That definitely had something to do with it. And look, the previous week we closed below the order block on the day that I took, or on the week that I took the trade on Friday, because Friday the bars closed on Friday. It closed over the order block. That was my entry signal. Okay. In addition to that, we have a V1. Here is bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Again, looking for those combinations. And a rejection of the negative third ATR channel. That's a deep dip buy component. So, if you want to get technical, why did I take the trade? What were the signals? Well, the first signal was a close under, close over the order block. So a rejection of the top of the order block, a rejection of the negative third ATR channel, and a V1. So I entered here 87.20. I position size correctly. I placed my emergency stop 2 ATRs below. On this particular trade, my excuse me, my stop is a close below the low halfway of the washout bar of the V1 here, 86.20. So I had a really good tight stop on this trade. Placed my 1.5 ATR trailing stop level above, and the next week it was about unchanged. Next week it went up a little bit. Next week it went up, hit some profit targets. Next week sideways, sideways. Here on the 28th, nice big move up. I hit profit targets, also got to trailing stop level. Next week didn't do much. Next week didn't do much. Next week didn't do much. Next week looked like it closed below the previous bar's low, but it did not. And then the next week moved up nicely again. So I took some profit targets there. Then we had the big, huge down week where, this definitely closed below the low of the previous bar's low after being in trailing stop mode. And I had to get out of the trade, half of the trade, for a loss of 0.59%. Now, all these profits that I took on the way up over all these months, do you see why taking partial profits can definitely be beneficial if you move up and up? Look, I'm taking off at profitable levels, profitable levels, profitable levels, because if you get something like this that just comes down and just, takes away all your profit, aren't you glad that you took some partial profits when the market gave them to you? So I did have to get out of half of the position for a loss of 0.59%. Again, my stop was halfway of that washout bar on the entry bar. The next week it went up a little bit. And then this particular week, it went up enough for me to hit another profit target. But the one thing I want to kind of make a point here is, look, we got back to the top of the order block. Even this week, we got into the order block, but again, rejected the top of the order block. So that's a good sign. So the remaining shares that I have on TLT up about 1.91%. So that's TLT. Let's go to DDM. DDM is a short position on the weekly. It's been a really big short position. Now, I've shown you a lot of green boxes below, which are the bullish order blocks. Well, there is such thing as a bearish order block as well. And this is highlighted by the red box here. So what is a bearish order block? Well, a bearish order block is when you have a high, you make a higher high, you break market structure to the downside in this case, and as soon as you break market structure to the downside, you now know where the bearish order block is above you. So in other words, if you go from a bullish structure and then change to a bearish structure, you want to short rallies. On the other hand, if you've gone from a bearish structure to a bullish structure, then you want to buy dips, right? I was just teaching my student Vivek that this week. It's very simple, but it speaks a million different words. Remember, if you are in an uptrend and you change to a downtrend, then, in my opinion, the proper move is to short rallies. If you're in a downtrend and you change to an uptrend, then, in my opinion, the correct move is to buy dips. Well, this one went from an uptrend to a downtrend. We have a high, followed by a pullback, a higher high, and then here on this particular week, we take out the previous swing low. This puts us into a bearish market structure, so I want to short rallies. Well, I did that here on the 31st of January because we rejected the bottom of the bearish order block. Bearish order block is your highest up bar close before market structure change. So on this particular week, we went into the order block, but it rejected it. I got short at 107.30. I placed my emergency stop 2 ATRs above because I'm short. My end of bar stop is a close above the high of the order block. I placed my 1.5 ATR trailing stop level below my entry, again, because I'm short. And the next week doesn't do much. It's down a little. Next week, up a little. Next week, down. It's good. I take some partial profits on this week. The next week closes up a little bit. The next week, down substantially. I hit multiple profit targets, and importantly, I get to trailing stop level. Now, because I'm short, if I have a close above a previous bar's high, I'm going to get out of half of my position. The next week down, more profit targets. Next week sideways, up a little bit. Next week started up but closed down. Next week here, huge move down. You remember that move? So, in this particular case, I was fortunate enough to be short, where I took off multiple profit targets into this weakness. The next week opened up down again, took more profit targets, but at the end of the week, it closed up. Now, I got out of half. I locked in half of my profits on this particular bar. Why? Well, from a deep dip perspective, right? Deep dips are one of the strategies that I use and one of the strategies that I teach. If I'm short and I go under 30 RSI and then close over the 30 RSI, well, that means there were no more sellers under the 30 RSI, and that is a signal for me to take some profits, half of the profits, in addition to all the intra-week profits that I took. And I did. I took off half of the profits for a gain of 25.62%. So it was a massive trade. But I still have half. The next week, down again, took more profits. This week, down again during the week, took some more profits. And right now, I'm probably pretty close to getting out of this trade. I have a rule, a deep dip buy rule on the short side, that if I ever get to the 35 RSI or lower, then if I close above the 5 EMA, that's going to take me out of the trade. Or alternatively, if I have a close above a previous bar's high, after rejecting the 30 RSI, I will get out of the trade. So look, the 5 EMA right now is at 82.80. We're at 81.20, so pretty close. So next week, if we close above the 5 EMA, I'm simply going to be out of the trade. And it was a great trade. If it goes lower, I'll continue to take profit targets until either I close above the 5 EMA or I close above a previous bar's high because I'm short. So the remaining shares on this particular trade up 26.64%. So massive, massive trades. And again, this was a bearish order block this time, highlighted by the change in market structure to the downside. So this was a massive trade. Nike. Okay, so Nike, just a simple deep dip buy. Excuse me, everyone. My apologies. I did buy Nike, not the last week, but the week before that, on the 18th of April. I bought Nike at 55.80. Why? Well, I like to have confluence of signals, so I had two signals on the weekly. During the week, we were under the 30 RSI. The end of the week, we closed above the 30 RSI. During the week, we closed below the negative third ATR channel. End of week, we closed above the third ATR channel. So there you go. That was the signal of why I entered. So I position size correctly. I placed my emergency stop 2 ATRs below. If I have a close below a previous, I'm sorry, if I have a close below the 30 RSI on a weekly ending basis, that is going to be my end of bar stop. But where did it end up? 33.75. So it did not close below the 30 RSI. Therefore, I am still in the trade. You can see here are my three profit targets for the week. One at 58.22, one at 60.68, one at 63.14. How many did I hit this week? I hit one. So I took off 10% of the shares that I went into the week with, and I still have 90%. So this particular trade, doing well, pretty good, right? Up 3.05% for the week based upon, this is strictly deep dip buy, no order blocks, right? Under 30, over 30, under the negative third, over the negative third. And by the way, I do teach deep dip buy in my one-on-one lessons, obviously, but I also have a video course on deep dip buys on udemy.com. It's a really great course. It has like 4.9 stars. I've sold so many of those around the world. And there's a lot of content. It's very affordable. Not sure where they have it priced on Udemy. I think it's between $30 and $50, but it's 9.5 hours of video, and I show you all the rules, everything you need to know about trading the deep dip buys. 200-day moving average, 250, 300-day moving average, under over 30 RSIs, and how to combine those together. But this is this is 100%. I trade exactly what I teach, and you can see that. It's here on this particular trade. Under 30, over 30, under the negative third, over the negative third. And so far, it's great. So if you're interested in watching the deep dip buy video lessons on Udemy, the links in the description. I think you'll really enjoy it. So on Nike, the remaining shares up 3.05%. And then brand new trade last Friday, or yesterday I should say, on XLV. And there's a lot of signals going on here on XLV. And I do want to thank one of my one-on-one students, Vivek from Canada. He messaged me on yesterday on Friday and said, "Hey, Greg, look at the setup on XLV." And the thing is, I was doing some other things. I was trading some other things. I didn't notice it. But as soon as I saw what he pointed out to me, I was like, "Oh yeah, that trade's perfect. I'm very likely will take that." So thanks, Vivek, for that. And I did take the trade, and now I'll explain it to everyone else. So multiple signals here. You see the green order block. Okay, well, that's one signal. What did we do on Friday? We went below the order block, closed back in the order block. That by itself is a legitimate signal. Let's look at the 200-week moving average. Now we're moving into deep dip buys. Okay, first one's order block, below order block, back in order block. Second is a close under, close over the 200-week moving average. That is a legitimate deep dip buy on its own. Number 3, we have a V1. Bar 1, bar 2, bar 2 goes below the low of bar 1's low, closes above bar 1's close. That is a V1. So it's a confluence of a rejection of the 200-week moving average. It's a V1, and it's a rejection of the bottom of the order block. So now the question is, because this is a combination of different strategies together, what is going to be my end of week stop? Obviously, I have my 2 ATR stop below here. That's easy. But in my what I'm going to do on this particular trade is if we close below the 200 week moving average next week, I'll just get out of the trade. But it has to close below the 200. And if it does, I'll get out of the trade. If the next week it closes back over, I can get back in the trade. And here's my 1.5 ATR trailing stop level above. So this trade is nicely set up with a nice confluence of signals, rejection of the order block, rejection of the 200-day moving average, throw a V1 on top of there for good measure. Position size correctly, end of bar, or I'm sorry, emergency stop 2 ATRs below, and end of bar stop will close below the 200. If it moves up next week, I will take partial profits. If it gets to trailing stop level, then I'll go into trailing stop mode. So right about where I bought it, so basically break even. So anyway, we'll see what happens on XLV. So those are the particular trades for the week. I mean, it's been a really, really, honestly, great year so far in trading the way that I trade. So Microsoft remaining shares up 6.41%, Q's up 11, the remaining shares up 11.85, Meta up 11.51%, Nvidia, the remaining shares that I had to get out at break even, TLT remaining shares up 1.91%. DDM, the short, remaining shares up 26.49%. Nike, remaining shares up 3.05%. And XLV, like I just mentioned, just got into the trade for even. So before we get on to next week's potential trades, let's talk a little bit about trading psychology. This comes from Linda Raschke. Linda Raschke is featured in Market Wizards. Look that up. Read her segment in Market Wizards. She's a great trader. I've met her myself. I've attended some of her classes, and she's probably the most famous female hedge fund manager in the world. And she really knows what she's talking about, and I really enjoyed her class when I took it. But let's see what Linda Raschke has to say today. Always discipline yourself by following a predetermined set of rules. Sound familiar? So I keep telling you, you have to know exactly what you are going to do regardless of what the market does. If the market does this, then you have to do that. If the market does that, then you have to do this. And the point is, you have to follow it. I know it's not doing what you want it to do. I mean, man, if the market would just do what we wanted to do all the time, you wouldn't be watching this video, right? I wouldn't be given this video. We don't know. We have to make decisions, and we have to have a predetermined set of rules. That's what I was saying. After trading for over 30 years now, I am so convinced beyond a shadow of a doubt that you have to have a plan that you follow day in, day out. You're going to have losing days, you're going to have losing months, you're going to have losing weeks. But if you have a good trading process and then you follow it consistently, that, in my opinion, is the only way to make consistent money in trading. And this is what Linda Raschke is telling you right here. Always discipline yourself by following a predetermined set of rules. Position size correctly based upon volatility. Have a good risk to reward ratio on your trades. Have multiple confluences of signals happening at the same time. There you go. Those are your rules. But are you going to follow them? You have to follow them, everyone. So thank you, Linda Raschke. Appreciate all your good advice. And now let's get on to potential trades for next week. All right. So I mention this every single week, but here on the daily time frames, I have 12 particular candidates for next week. Now, theoretically, all 12 of these could trigger on the same day. Does that mean that I am going to pick all 12, take a position in all 12? Absolutely not. Part of my trading rules rules are that I only take one trade per day per time frame. So if all 12 of these signals were to signal on Monday, I would still only take one. But the question is, well, how do you know which one to take out of 12 if they all 12? You have to narrow it down to the best trade. And the way that the way that I determine what the best trade is I give each trade a quality score. For example, if one stock has one entry, that's it. I give it 1 point. If it has two entries, obviously I give it 2 points. And if the next one has three entries, three entry signals, I'm going to give it 3 points. Well, which one do you think at the end of the day I'm going to pick? I'm going to pick the one that has 3 points, not two, not one, right? So, but I look at it, multiple signals, what's the risk to reward ratio, what does a higher time frame look like, and what is the relative strength of this market compared to the market in general. And again, this is what I teach all my students to do, is to pick the best trade out of a group of legitimate trades. You have to be able to figure the best one. And like I said, that is what I teach all my students in my one-on-one course to do. And I would love to have you as a student. So like I said, just reach out. We can get the conversation started. But I want to be very clear on that, right? That here are 12 symbols for next week, and they all could trigger on the same day. I'm only going to take one. And I'm going to just do that by looking at multiple confluences. What is the risk to reward ratio, higher time frames, and relative strength. All right. Okay. Let's take a look at ARK. ARKK. Looks super bullish right here, doesn't it? Well, it does. However, do you see the red box above here? This is a bearish order block, everyone. Here's your highest up bar close before we change market structure to the downside. I am looking for a short on ARK. Now, I'm looking for a short in two different locations. The first is the 200-day moving average. This is the black line. If next week, Monday for example, if we reject this 200-day moving average, I very well may get short ARK, with the 200-day moving average being my line in the sand. Short below it, out of the trade, closes above it. So that's the first level that I'm looking for a rejection. And if you've been listening to this podcast for a while, you will remember me saying, do you see the gray line? That is the 50-day moving average. The 50-day moving average just closed under the 200-day moving average. That's called the death cross. Long term, that is a bearish position or a bearish signal. But what I have noticed is that the first time you move up and reject the 200-day moving average after the death cross has happened, that's generally a very good time to short the market. So the death cross has happened. We have not yet rejected the 200, but if we do, it gives me a good risk to reward ratio. It gives me a very well-defined line in the sand. So next week, if we reject the 200-day moving average and close below it, then I will consider getting short there. Alternatively, if we just power up and close back above the 200, then I'm not going to short it, but I would be looking for the order block to be rejected, either the bottom of the order block or the top of the order block. You can see the order block, the low is 52.71, the high is 54.24. So either rejection of the low at 52.71 or rejection of the high 54.24, I would consider getting short. I would position size. I would place my emergency stop 2 ATRs above. And then my end of bar stop would simply be a close back over the high of the order block at 54.24. So yeah, I am looking for short positions here right now on ARK. So we'll see how that plays out. Berkshire Hathaway, well, you see the red box, therefore you know I'm looking for a short. Why the red box? Well, we have a high, we have a pullback, we have a higher high, we have a break in market structure. And so if I have a break in market structure to the downside, I want to short rallies back to the order block. Let me get a drink of water here, everybody. My voice is giving out a little bit. Okay, did we reject the bottom of the order block on Friday? No, we didn't. We closed back above. You can see back here on the 14th, we did reject it and close below. We did reject it and close below. Then it did move down. I didn't short that. 3 days ago, we rejected it, closed below. Could have taken the trade there. I did not. But I'm looking here now. It closed above. If it closes like slightly below on Monday, I could potentially get short there. I position size, place my emergency stop 2 ATRs above, and then my close would just be a high above the high of the order block at 539. So I don't know if I'll take this trade or not. Like I said, I have 12 potentials here. If this is just one signal, maybe I don't take it, because maybe one of the other symbols in one of the other markets has 3 or 4 or 5 different signals. I'm certainly going to take the highest one, right? Like I was just talking about. But I am keeping my eye on Berkshire for a potential short, because we are back into the bearish order block after changing market structure to the downside. GDX, gold. Okay. Well, gold's been on a tear. And this is GDX. This is the gold miners. But there is some structural damage to this chart. Let's take a look of why. Well, back here on the 16th, we have a high. We pull back. We make a higher high. And then here on the 22nd, we close below the pivot, changing the structure from bullish to bearish. If it changes from bullish to bearish, I want to short rallies back to the order block. The order block here is the highest bar close before market structure change. The low of the order block is at 51.29. The high of the order block is 52.81. So I still would need more of a check back in a rejection of the bottom of that order block or the top of that order block. The only other kind of audible that I may call is a rejection here at $52. Why this here? Well, for one, it's in the order block. Two, look at the big down bar we had here on the 21st. We went much higher, closed below. When you have a downward closing bar like this, then if you ever rally back to halfway of that downward close, that is where you're going to encounter some pretty significant resistance. So on just a single bar, getting to the halfway, you're going to have inherent resistance. But because that bar resides in the bearish order block, see what I'm saying? So there's 3 levels really next week on GDX that I'll be looking for. I'll be looking for a rejection of the low of the order block of 51.29, a rejection of the halfway of the big down bar at 52, or a rejection of the high at 52.81. All right, so that's GDX. India. Earlier in the podcast, I was talking about abandoned babies, and this just reminded me. Do you remember this trade I took back here in March? Gap down, followed by a gap up. What's that called? It's an abandoned baby. Look at that. Gap down, followed by a gap up. Look at that move. That was a great trade. That was a great trade. So now what do we have? Well, we have a high, pullback, we have a higher high, and on Friday, we closed below the first pivot point after that high, pullback, higher high. This changes us into a bearish market structure now. So if I'm in a bearish market structure, I want to short rallies. Well, where are those levels to short? Well, highest up bar close before change in market structure was Thursday. The high is 53.77. The low is 53.16. So I'll be looking for a potential short on India with the rejection of the low at 53.16 or a rejection of the high at 53.77. So just a short position there. Let's look at MasterCard, MA. Well, here's your red box. Highest up bar close before we change market structure to the downside. Sold off with everything else. Now it's rallying. If I change market structure to the downside, I want to short any previous or any subsequent moves back up into the bearish order block. We're not there yet. You can see a few days ago we got close to rejecting the bottom of that order block. So the low of the order block is 546. The high is 560.94. That's the high and the low of the order block. So rejection of the low of the order block or rejection of the high of the order block, I would certainly consider getting short. What I really like is I like the low of the order block, this one. Why? Well, look, back here on the 28th, we have such a big down bar, but look where the halfway is. The halfway, that big down bar is basically the low of the order block. So really, I specifically am going to be looking for a rejection of 546.93 for a potential short. Merck. All right, Merck's kind of interesting because we have been talking about bearish order blocks for the last 25 minutes. Now let's look at some bullish ones. Well, look at Merck. We have a low, we have a rally, we come down, test the low, and then on Friday, we close above previous swing high. This now changes the market structure from bearish to bullish. And if you change from bearish to bullish, then I want to buy dips. So that is why this is green. It's our lowest bar close before we change market structure to the upside. So therefore, on Merck, if we pull back to the top of the order block and reject it, that would be a buy. If we pull back to the bottom of the order block and reject it, that would be a buy. And then you see the green line in the middle. What's that? Well, I was just talking about big down bars and getting to halfway to short. Well, this is the opposite. On Thursday, we had a big up bar. Therefore, there will be inherent support at the halfway of the big up bar at about 77.60. I mean, should be. More times than not, there is. And that halfway of the big up bar, that internal support there, also resides in the bullish order block. So to me, Merck has changed its structure to the upside. I'm not going to chase this here, but if we do come back, reject the high of the order block at 78.69 or reject the low of the order block at 75.93, those would be two entries. The third would be a rejection of the halfway of this big up bar here on the 24th. Say Monday it comes down, goes below, closes back above, then that would be potential entry for me as well. So Merck looks pretty good here. Don't want to chase it, waiting for a pullback. Palantir, PLTR. All right, well, I'm looking for a short, but I do want to point out, you see the green order block down here? This was from a previous bullish order block. Look here, on the 7th, look how close we got to that order block before we had this huge move up. Order blocks are no joke, everyone, bullish or bearish. But now we are coming into a potential bearish order block. Why? Well, here is your highest up bar close on the 18th of February before a sharp market structure change to the downside. Got down to the bullish order block, bounced almost to the penny, and now we are rallying back up to the bearish order block is where I would be looking for a potential short. So the low of the order block is 118.43, the high is 125. So I just need to be patient here and wait for some kind of rejection of the bottom of the order block or the top of the order block for a potential short position. Silver. Okay, It's a red box. It's a potential short. Here on the 27th, highest up bar close before market structure change. Therefore, I want a short. Rallies back to the bottom or the top of the order block. You can see a few days ago we almost got there, and that's exactly where it failed. So, not going to do anything with silver unless we reject the bottom of the order block at 30.68 or the high of the order block at 31.38. United Airlines. All right, so United Airlines, you see the green box here, so that means we have changed market structure to the upside. Why? Well, here we have a low, 31st, we rally, we make a lower low, and then here on the 9th, we take out that swing high. That changed the market structure on United Airlines from bearish to bullish. Now, the change market structure to the upside, lowest bar close before market structure change, this becomes our bullish order block. And so for me to get potentially long United Airlines, I need to come down and reject the high of the order block or reject the low of the order block. And the order block level is 62.28 at the high, 55.18 at the low. So I'll be watching United Airlines carefully for rejection of the high of the order block at 62.28 or a rejection of the low of the order block at 55.18. Natural gas, UNG. I've been watching this carefully, just has not quite given me the signal. You can see I've been talking about this for a while, but here is the green order block. And I thought Friday we were going to close back into the order block, which would have been a legitimate signal, but we got right to the bottom and it closed back below. But next week, what I am looking for is a close back in the order block that would potentially get me long. Technically, we did get a buy signal on UNG on Friday. Look at the RSI. The RSI is 30.84. So we did open below the 30 RSI, close back above the 30 RSI, which technically is a valid signal. I did not get long this signal yet because, like I just said, I wanted to close back in the order block to give me more confirmation on the trade. So I'll wait and see if that happens. The low of the order block there looks like it's 15.92. The high of the order block 16.28. So at the very least, it's going to have to close above 15. Make sure that's the right price. 15.88. Excuse me. 15.88. We're at 15.7 right now. So that's what I'm looking for potential long on UNG. Walmart. Okay. So here's the green order block. Why? We have a low. We rally. We make a lower low. Here on the 9th, we change market structure to the upside. So if I change market to the structure to the upside, I want to buy dips back to the order block. So the order block below us is 86.96. The low is 81.03. So if we came down, rejected the high of the order block at 86.96, that would be a level. If we reject the low of the order block, 81.03, that would be a level. Or look at the 200-day moving average, the black line that's sitting inside the order block. See, this is the combination of order blocks and deep dip buys. I love these particular trades. When you have a major moving average like a 200, a 250, a 300, or a 30 RSI that's inside the bullish order block. And there you go. So 3 options if Walmart pulls back. It may not pull back, but if it does, want to be ready with rejection of the high of the order block at 86.96, a rejection of the 200-day moving average, which is the black line, which is at 85.19, or rejection of the low of the order block, which is 81.03. Okay, last one on the dailies, XLE. Had a nice rally on XLE. You see the red box. That is telling you that I'm looking for a short. Why? Highest up bar close on the 2nd of April before obvious market structure change to the downside, looking to re-short, looking to short XLRE if we reject the high or the low of the order block. The high of the low of the order block, the low is 41.60, the high is 42.17. So some rejection of the bottom of the red box or the top of the red box. May not get there. If it doesn't get there, I'm just not going to take the trade. So those are the dailies. Let's switch over real quick to the weeklies. I don't have too many of them. But let's get these as well. You know, I don't talk a lot about Bitcoin. I really don't. But this is a legitimate signal. Look at the green box. This is your weekly order block. We have a low back here on 314. Then we rally. Here on the 11th, we make a lower low. And then this week, we take out that first swing high after the lower low. This now changes the market structure from bearish to bullish on Bitcoin. And if you change from bearish to bullish, I want to look for dips to buy. The dip to buy signal, there'd be 3 levels on BITO. The first level would be the high of the order block at 1835. The next level would be a rejection of halfway of the big up bar. Remember, if you have a big up bar, halfway of that big up bar, there's going to be some support. So I look for rejection there at 1740. Or if Bitcoin goes down, a rejection of the bottom of the order block at 1648. So this looks really good. I'm not going to chase it here because it's a bit extended, but now that we changed structure to the upside, it makes me feel a lot more confident buying the dips. But the first one would be rejection of the higher order block. Next one, UUP, which is the dollar. Dollar has just really not done well lately, but look, we got on a weekly basis, we got right to the long-term order block. That's exactly where we bounced. It's a little extended. I could have taken the trade, but I didn't. I would look for a little bit of a pullback, maybe retest the high of that order block at 27.14. And then last but not least, we talked about the change of market structure on Walmart on the daily, looking for a pullback after market structure on the daily. However, on Walmart, we have 2 things going on here. On the daily, we have a bullish order block. On the weekly, we have a bearish order block. What makes it bearish? Well, back here on the 14th of February, Valentine's Day, was your highest up bar close before you change market structure to the downside. So we're kind of in no man's land right here. But on a weekly time frame, if we reject the high, or I'm sorry, the low of the order block, the bearish order block at 100.97, that would be potential short, or a high at 105.01. So this is on the weekly time frame, this is the bearish area. On the daily time frame, the green is the bullish area. So you can see it's kind of stuck in purgatory. You know, I'm not going to do anything with it right now. But on the weekly, if it goes higher and rejects the bottom of that bullish order block, I get short. On the daily, if it goes back down and rejects the bullish order block, I get long. So anyway, lots of stuff we covered. Oh, I apologize. I told you, let's take a look at the Qs and the SPY to end things off here, okay? Just to kind of give you an idea. Now, here are the Qs. I'm in the Qs. I am long the Qs. But if I was not long the Qs, would I be jumping in here now? Really, I would not, everybody. And let me explain why. Here is a bearish order block on the daily. Highest up bar close before you change market structure to the downside. That is a bearish order block. That could be 3-4 days away, 5 days away. But if we get there, a lot of bearish confluences. Bearish order block, 200-day moving average above you. I talked about the 50 crossing below the 200. That's the death cross. That happened. So when you have that happen, then your first move back to the 200-day moving average is generally a good place to short, and that also falls into a bearish order block as well. So do you see why I'm so bearish on this? I mean, yes, I'm in the queues. I will continue to just trade what my process tells me. That's totally fine. But as far as entering a new position here, look, the market's moved substantially. And is this a bear trap? It certainly could be. But this order block here, the death cross here, the 200-day moving average here, these are significant resistance levels. And I would not be surprised at all by two things. One, that we get there, or two, if we do get there, we have a big move down again. I think that's possible. So be a little careful about just jumping into the queues with those levels above. So that's the queues, and then let's look at the SPY as well. Same thing, everybody. We have the death cross, 50 cross below the 200-day moving average. In my experience in trading, when you have a death cross, the first move to the 200-day moving average is a good shortable area. Again, that dovetails with your order block, your bearish order block here, which dovetails with the 200-day moving average. So that concerns me. That concerns me quite a lot. So my best advice would be patient, wait for some good deep dip buy setups or some pullbacks to order blocks. But right now, if you're long this market and all you're hoping for is just momentum to carry you higher, maybe it has it, maybe it doesn't, but I would be very, very careful. So anyway, everybody, I hope today was helpful. If it was helpful, I really would appreciate if you could hit the thumbs up button. It lets YouTube know that, you know, somebody's watching the channel, they're finding it valuable, and it really helps out in the algorithms. And if you haven't subscribed yet, if you could do that, that would be really great as well, and I would appreciate that. Remember, I love to teach. I teach a great 15-hour one-on-one course. I teach you everything I know, all the different trading strategies that I use. To make that happen, all you have to do, just send me an email, and then we'll just jump on a call. And it's not a sales call, everybody. It's just me getting to know you, you getting to know me, seeing if we're a good fit, okay? And so anyway, look forward to that. Look forward to your email. If you'd like to take the Deep Dip Buy course at udemy.com, the link's in the description. It's very affordable, 9.5 hours of content, really great there. Please try to do something nice for someone every day. It would make the world a better place if you did. If you could also do one nice thing for an animal, that would also be great. I was raised with a lot of animals. I know they appreciate acts of kindness just like we do. But I appreciate you being here. If you have any questions or comments, put them in the comment section. I'll do my best to get back to you, but I hope you have a good week. Get yourself a trading process, follow the trading process, and if you have any questions about anything, like I said, put them in the comment section, and I'll try my very best to get back to you just as soon as possible. So I guess that's it. Thanks for your time, everyone, and on the way out here, I have to run the U.S. legal disclaimer. Thanks a lot. We'll talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice. and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.